If you have a mortgage, a 401k, or a single dollar in the market, the next 90 seconds matter more than anything you'll read this week. The Fed just changed its direction. They're now projecting higher rates, inflation just hit a 3-year high, and $10 trillion in government debt is about to reprice at the worst possible time. Here's exactly what happened, and more importantly, what it means for your money. This week, the biggest central banks on the planet all met. 5 major central banks, 5 separate rooms on opposite sides of the world. And every single one of them either held rates exactly where they were or pushed them higher. 2 of them actually hiked. And the last time we saw this many of the world's central banks tightening in the same breath, it was the front and center of the last regime. It lasted years, not months. Meanwhile, the equity market spent most of this year repricing in cuts that just got taken off the table in the span of a week. So today I'll walk you through the synchronized freeze and what it actually signals, the wall of debt that just got its clock reset, and what all of this means for your mortgage, your savings, and your money over the next year. Hit the like button, subscribe to the channel, and if you want the full framework on the 18-year cycle and where this all fits into it, the free 3-part mini course is linked in the top of the video description. It's completely free, so go grab it now. Let's get straight into the data. Let's start with the Fed, because that's the one everybody is watching. This week, the Federal Reserve held rates at 3.5 to 3.75%, 4th hold in a row at that level. But the hold isn't the story. The story is what they said around it. This is the first meeting under the new chair, Kevin Walsh, who replaced Powell. And the updated dot plot, which is basically each official's guess for where rates end up, moved in the wrong direction for anyone hoping for a relief. The median projection for year-end got bumped up to 3.8%. Out of 18 officials, 9 of them are now penciling in at least 1 rate hike before the year is out. Only 1 is projecting a cut. They also revised their core inflation forecast for the year up to 3.6%, which is a big jump from the 2.7% they had just talked about a few months ago. And here's the part that really told you where their head is at. They stripped the easing language out of the statements entirely. For the first time, the little hint that cuts were on the way, they're gone. The market read it instantly. Roughly $420 billion in market value got wiped out in the 30 minutes around that announcement. The 2-year Treasury jumped to 4.2%. Now here's where it stops being one cautious central bank and starts being a pattern, because the Fed wasn't acting alone. In the same week, the Bank of Japan hiked to 1%. That doesn't sound like much until you realize that it's the highest interest rate Japan has had since 1995, making it a 31-year high. An entire generation of Japanese investors has never seen rates this high in their adult lives. Then you've got the European Central Bank, which hiked 25 basis points to 2.25% just days earlier. And that was their first rate hike since September 2023. It's nearly 3 years now. A complete reversal of the direction they were heading. Eurozone inflation had ticked back up to 3.2%, and they're now staring down growth of just 0.8% for the year, which is the kind of combination that gives central bankers nightmares. The Bank of England held at 3.75%, the Reserve Bank of Australia held at 4.35%, and openly warned that more hikes might be coming, even though the banks aren't suggesting it. So put it all together. 5 of the most powerful institutions in global finance, and the most dovish thing that any of them did was stay put. When 5 separate committees with 5 separate mandates looking at 5 separate economies all arrived at the same decision in the same week. The thing forcing that decision is not local. It looks to be structural. And it gets worse when you understand that every one of these borrowers was waiting for a cut. Because here's the trap that just snapped shut. The wall of debt that I opened with isn't one thing, it's a stack. The single biggest piece is the US government itself, somewhere around $10 trillion in treasury debt maturing this calendar year alone. On top of that, you've got trillions in global corporate debt rolling over and close to $1 trillion in commercial real estate loans hitting their maturity window all at once. And almost everyone holding that debt made the same bet. They bet that by the time they had to refinance, rates would be back down to near 3% or lower. Instead, they're staring at 5%. Now, a lot of these borrowers already kicked the can down the road once. In the real estate world, there's a strategy people politely call extend and pretend. When a loan came due in 24 or 25 and the numbers didn't work, the lender just extended the term. Modify it, push out the maturity, pretend everything's fine, and bet that rate cuts somehow show up before the new deadline. It's crazy, but this is what institutions do. Nearly $1 trillion of commercial real estate debt that matured last year didn't actually get paid off. It got rolled forward into this year and next. So all that debt got piled on top of the debt that was already scheduled. And those extensions are now expiring straight into the highest rate environment we've seen in this cycle. The exit they were waiting for just got blocked a second time. Could it be a third time? I'm sure there is a possibility. Let me show you the actual pain, because this is where it gets real. A lot of this debt was written in the mid-2010s at rates between 4.1 and 4.7. Refinancing today puts you closer to 6.5%. For the cleanest investment grade borrowers, you're talking about going from 2% coupon to a 5% coupon. That's not a tweak to the budget. That more than doubles what you've got to pay to service the same loan. And for some of these borrowers, they can't take that hit. Around 14% of private credit borrowers already don't earn enough to cover the interest they owe right now. Roughly 10% are using something called payment in kind, which basically means they're borrowing more money just to pay the interest on the money they already borrowed. These are companies treading water at today's rate, and the refinancing wall hasn't even fully hit yet. The office sector is the ugliest corner of it. Nearly 70% of office loans are failing to pay off at maturity. That's not a warning sign, that's a fire already burning. So you've got the debt, you've got the rate gap, and now you've got the central bank slamming the door shut. That's three things lining up, and the people running the system know it. Now here's the part I really want you to understand, because it reframes the whole thing. This synchronized freeze didn't come out of nowhere. The thread running through all five of these decisions is energy. The conflict in the Middle East, the disruption around the Strait of Hormuz, sent energy prices ripping, and that fed straight into inflation everywhere at once. US inflation hit 4.2% in May, the highest in over 3 years. There was reportedly a peace deal announced around the middle of June aimed at reopening the strait, and that's genuinely hopeful, but none of these central banks pivoted on it. They all took the wait and see approach because they've been burned before. And honestly, can you blame them? Rewind to 2024 and 2025. That was described as the fastest rate cutting cycle outside of a recession in decades. Central banks cut aggressively while their economies were still standing. And what happened? Activity re-accelerated, inflation got sticky, and they had to slam the door shut again. The last time the Fed actually cut was December of last year. Since then, 4 straight holds and a hawkish turn. The whole global easing cycle effectively ended, and most people watching their screens didn't notice until this week. So when a borrower says the cuts will come and I just need to hold on, the central banks are looking at the last cycle and saying that they tried it and it cost them. So can you honestly say that they're going to do it this time to rescue everyone? I don't think so. And there's a new wrinkle that makes the timing even harder to plan around. Kevin Walsh, the new Fed chair, has spent years criticizing forward guidance. He thinks telling markets what you're going to do ties your hands. So at his first meeting, he didn't even submit his own dot plot projection. The chair of the Federal Reserve declined to tell the market where he thinks rates are going. He's setting up task forces to overhaul how the Fed communicates. More task forces means more tax paid. Just an absolute shit show, right? Let's get back to it though. This is a polite way of saying the Fed is going dark and data dependent. For a borrower trying to time their refinancing, it's basically brutal. You can't even plan around a pivot anymore because the man in charge just told you what he won't signal one. I don't think it's a problem, really. They shouldn't be telling us what they're going to do. If they're going to do it, they should just do it. So I don't think Walsh has done a bad job here. But anyway, let's take a look at the part that almost nobody on financial TV connects, which is who the biggest borrower in the whole mess actually is. I think you and I know it. It's the government keeping the rates high. The US government has around $10 trillion rolling over this year, and it's refinancing all of it at these elevated rates. Annual interest on the national debt is now hovering near $1 trillion a year. That's larger than what the country spends on Medicare. The average rate on US marketable debt has more than doubled in 5 years, from under 1.5% to around 3.4%, and it keeps climbing as old cheap debt gets swapped for new expensive debt. The 30-year US Treasury is very close to hitting 5% and maintaining it, one of the highest levels in 2 decades. And recent auctions are already showing weaker demand, which means investors are getting nervous about lending to the very government whose central bank is holding rates high. It's the most reluctant participation in decades. Japan's in the same bind with a debt pile around 250% of its economy, where even that small hike to 1% could eventually cost it a brutal chunk of its GDP in extra interest. So now you've got a problem on the debt side and a problem on the liquidity side firing at the same time. Now, none of this clicks into place until you see it through the framework, and that's exactly what the free 3-part mini course is built for. Part 1 walks you through the 18-year cycle and the 220 years of data behind it. Part 2 shows you exactly where we sit in that cycle right now. And then Part 3 is how to position for what comes next. It's completely free, and there's a link in the top of the video description. Here's how it all ties together. The framework has already said that the late stage of the cycle is where credit gets stretched to its absolute limit, and then the conditions that let everyone roll their debt forward quietly disappear. That's what a synchronized freeze actually is. It's the financing window closing on a generation of cheap debt all at once. And the reason synchronized matters so much is spillover. When central banks move together, the effect gets magnified. A coordinated easing pumped this debt bubble up faster than normal. A coordinated hold, or worse, a coordinated tightening, forces every investor on the planet to reprice risk at the same moment. So basically credit getting sucked out of the system all at once. There's nowhere to hide because there's no central bank cutting to catch the falling knife. Now, I want to be clear because I'm not here to scare anyone into doing something stupid with their money. This refinancing wall doesn't collapse tomorrow. It grinds over through the next 12 to 18 months. Extensions expire and one cohort of borrowers see the effects one at a time. But the sequence is in motion, and this week confirmed it. Affordability of credit has broken, the easy rollover is gone, and the distress is already showing up in the weakest corners first. That's the cycle running right on schedule. So let's bring all this together and talk about what it means to your money, because obviously that's what matters here. If you own a home with a low fixed rate, you're not wrong to stay put. The 30-year mortgage is sitting around 6.5%, and the Mortgage Bankers Association is now forecasting rates averaging around 6.5% all the way through to 2028. Trading a sub 3% mortgage for that resets your entire financial position, and the lock-in effect that's freezing the market could easily last a couple more years. If you're a saver or you're sitting in cash, you're actually on the right side of this for once. Short-term treasuries near 4.2%, money market funds, high yield savings. That's the mirror image of what's crushing the borrowers. A higher for longer world is genuinely good for the patient. And you can also find some products that are even higher than inflation, giving you interest rates above that point. So you're basically beating inflation while sitting and doing nothing. And this is the problem at the peak of the cycle. You're incentivized to do nothing with your market. At least that's the direction that it has to go to reduce inflation. Now, if you run a business with floating rate debt or anything maturing in the next 2 years, the runway of waiting for cuts has effectively closed. The smart move now is to stress test your refinancing position and look at your options before your extension expires, not after it. Because the institutions that get caught here are the ones that still are waiting to be rescued. And like we've been told this week, it doesn't seem like it's coming. I know it sounds a bit grim, but I do these vids so you guys are prepared, not to add more fuel to this crazy euphoria we're living in through these days, but to obviously prepare us for what the next stage of the cycle brings. If you want a deeper dive into what we're doing with our portfolios or want more information about the 18-year cycle, remember there's a link in the top of the video description. One for the 18-year cycle and the other is for our members community where we discuss our portfolios. So that's it from me today, guys. Have a fantastic weekend and I'll see you at the next video. Until then, take care and peace out.